Should I trade or hold? I mean, which one's better? It's an age-old question, but in this video, I'm going to show you data and facts to help settle this once and for all. And at the end, I'm going to give you a simple, easy to follow plan so you can have massive success with your own investments. So stay tuned. All right, welcome back. So we are going to tackle another argument that we hear all the time. Which one is better? Should I trade or should I hold? And which one should I use? Which one should I do? And which one is better? And so first of all, let's kind of break those down, right? So trading is trying to time the market. You're trying to buy low and sell high, which I guess investing is as well, but trading is short time frames, right? So you're not really concerned with the asset itself, any fundamentals of the asset. You're just trying to take advantage of small price movements. So buy it here, sell it here. The volatility as prices go up and down, you're trying to get in and out, in and out, in and out. And you're trying to time the market. Whereas investors look at a fundamental basis of an asset and say, look, I'm buying it here because these things are happening. And when these things are happening, the market share is going to grow and the price is going to go up. And so I'm going to buy it and I'm going to hold. And I know it's going to be volatile along the way, but I believe when I'm going to buy it here, it's going to go to here. So that's kind of the difference. And so the question is, should you hold, buy something here and hope that it gets here, or should you trade it along the way? And that's what we're going to take a look at. So the question is, are you that good, right? Markets are super explosive. And they're very hard to time. As a matter of fact, you've probably heard the saying, trying to catch a falling knife. And so that's what most traders are doing, right? As the prices come down, they're trying to catch the bottom, catch the bottom, catch the bottom. And so they keep trying to catch a falling knife, right? Imagine just trying to catch a falling knife, how dangerous that is. And so an investor would rather wait for the market to settle, show an uptrend, and then invest into that uptrend. And the problem is that markets are very explosive. There's lots of little moves, but when they decide to really move fast, they can move up and down really, really fast. And so if you're on the wrong side of that explosive move, it could be really, really bad. So I'm going to show you why I think that holding is better and show you some of the facts about that. So the first thing is with trading is that you're going to miss some days, right? You're going to be out of the market. So what's going to happen is the markets are starting to go down, and maybe they're starting to go down pretty quickly. And so you get spooked, you get scared, and you're like, I'm going to get out so I can buy back in, right? Bitcoin just dropped $1,000, and everybody on Twitter is telling me, dropped from 10,000 to 8,000. Everyone on Twitter is telling me it's going to drop to 4 or 5. So I'm going to get out. I'm going to wait for a better entry, right? So I got spooked, I sold, I got out. And what happens is, I'm out of the market. I'm missing some days. Now, my point is to buy back in when it's lower, but how realistic is that? So let's take a look at that. Let's take a look at what just missing a couple of days could mean to you. So first thing we're going to do is we're going to look at, with Bitcoin, we'll look at what could 10 days mean. 10 days. And not 10 days in a row. We already know that. But so this is some new research that just came out on Bitcoin. This is by Tom Lee from Fundstrat. So shout out to him for putting this chart together here. But basically what this chart is showing here is this is showing that if we looked at the best 10 days of the year, all right, so this is from 2013 to 2019. So this is every single year. If we look at just the best 10 days out of 365 days a year, and we took those out of the market. So, the market was going down, I sold out, and I sat out for a couple days and I got back in. If you sat out best 10 days, you would go from making a lot of money in Bitcoin. Imagine buying Bitcoin in 2013 and holding until now. You'd go from making a lot of money to actually losing money. That's right. You actually lost money if you missed the best 10 days of the year. To kind of break this down for you, in 2013, you would have had a loss of 200%. In 2014, loss of 133%. 2015, loss of 50%. In 2016, you would have gained 22%. 2017, gained 232%. 2018, lost 140%. 2019, gained 70%. For a total of a loss, right? Just by missing the 10 biggest days each and every year for that period of time. Amazing. I mean, 2017 was like a 1,200% gain for the year. But if you missed the 10 best days of that year, you went from like 1,200 down to 200. I mean, that's a massive shift. And the thing is how do you know when those 10 days are, right? You don't. And typically, after the worst down day, the one that spooks you out and scares you out of the market, is typically when you get that rebound, which is one of those best days of the year. And that's why it's really, really hard. And this is not just Bitcoin. As a matter of fact, I mean, Bitcoin has been around for a shorter time period, so we don't have a lot of data on that. The stock market is a much bigger market, right? Not anywhere near as volatile, obviously, as Bitcoin. It's been around a lot longer, but the stock market's no different. As a matter of fact, it actually backs up this data in a lot more conclusive evidence. So if we look at the stock market over a 20-year period, 20 years from 1999 to 2018, and you miss the top 10 days out of 20 years, not in a year like with Bitcoin, you missed the top 10 days over 20 years, your return was cut in half. Half, just for 10 days out of 20 years. And if you miss the best 20 days out of 20 years, you actually lost money. I mean, is that crazy? I mean, 20 days over 20 years. I mean, it's just a small amount of time, but it dramatically changes the results that you get. And I mean, with so few days, how do you know when you need to be in them? I mean, how do you know which days are going to have that massive impact on you, right? I mean, 20 days takes you from being profitable over 20 years to being a loser in 20 years. And like I was saying before with Bitcoin, the same is true with the stock market, is that the best days almost always come right after the worst days. So right when you're getting out of the market rebounds. For example, in December of 2018, the stock market sold off pretty heavily in the last month of the year and basically gave back the gains of the whole year. And a lot of investors thought that the market was over. I didn't, but a lot of people did, and they sold out. They got out of the market. Well, the market rebounded in January and February. But most of those investors hadn't gotten back in yet. So now they sold out at the bottom, gave up all their gains for 2018, and then missed that rebound in 2019, right? So you have to recognize that it's very difficult to time the market, right? It's very difficult. And that's why some of the best investors and some of the best investing advice says it's about time in the market, not timing the market. Does that make sense? Don't try to time the market. Put your time in the market, all right? And really, obviously, it's going to require some good research to do that, because you're going to need to know, should I stay in, right? Are there fundamental reasons why I do that? Traders don't really look for that, right? They're looking for short-term price movement, but that's how we want to look at that. Now, the lesson with this is the lesson, is that you should stick to your investment plans, all right? So if you believe that you're buying this asset and there's fundamental reasons why it's going up in value, and I believe it's going to go up in value, then I need to stick to my investment plan. And don't get shaken out by this short-term volatility. Then that will help me to ride out the bad days over time. That way I don't panic sell, get out, give up my profits, and then miss the bounce back, right? And I know it seems harmless to sit out for a day or two, but I've talked to, I don't even know, hundreds of people who have sold out only to hope to buy back in lower and never did. They never did. And maybe they took a little bit of a loss, they sold out to cap those losses, but the market bounces back, and now they've lost even more money. And so if you're in an asset that you believe is going up in value over the long term, like Bitcoin, for example, like I still believe the stock market has room to go up here before it's all said and done, we need to be able to stay in it. It's not harmless sitting out when you miss the best days, because missing the best days really, really adds things up. So the way that we weather the storm is through asset allocation, and not just regular asset allocation. What I like is tactical asset allocation, where we're actually moving around with the market, especially in today's market, because the markets are starting to move really, really quickly. I believe we still have some good upside, but there's danger on the horizon. And so we want to use smart allocation, tactical asset allocation, to divide up those assets, and that's how we weather that. And we split up our total investable assets into different areas. And what that does is it lowers our volatility and it increases our returns at the same time. And what happens is we may see a little piece of our portfolio drop, but the rest goes up. And so overall, we can sit back and look at that as a whole, and we can feel comfortable with that. And that's what allows us to weather the storms. If you guys want to know more about that, there's a report I put together down below that shows you the 4 areas that I like to put my money into, divide my assets into. It's super easy. Like I like to make most things, take complex things and make them easy to understand. If you like easy, give me a thumbs up on this. And if you like the video, give me a thumbs up on this. If you don't like the video and I was bad, then give me a thumbs down. Hopefully that's not the case. Other than that, leave me comments. Let me know what questions you have about this. I answer all the questions and comments down below. So let me know what you think. If you have questions, how you can apply this. If I'm missing something, let me know. Give me a thumbs up if you like it. And that's it. To your success. I'm out.